All right, folks, I thought I'd do a little update, and we're trying to get high tech here, and I thought I would do a video. I hope you like this format. I will publish more of them in the future. I will not send you so many that they deluge your email box, but I think it is a good technique, and I'm going to try and keep these short and sweet. So I'm going to get moving, and I'm going to keep up a fast pace here so you can watch this and get on to the other things you're doing in a very busy life. So market update, we're going to go over the bad, we're going to go over the good, we're going to go over what you should be doing, and what we're doing. All right, so first the bad. Obviously we had a bad market last year and a particularly bad December. And typically, if you look at historical monthly charts for December, going back since the stock market started, December is typically a strong month, and they call that the Santa Claus rally. But instead, we got the Grinch that stole Christmas. So, obviously that was bad. At the time, it felt like a bad sign. And along with that, we had another negative, which is volatility. So that's, violent and choppy downturns. And there's several measurements of volatility, but they were very volatile, and that hurts things. I've also always found it, strange that they don't measure volatility to the upside, but the rocket scientists in the financial world that make up these terms haven't done that yet. But very volatile. I expect that to continue. I'll list several reasons why here in a little bit. One of them is Trump seems to cause volatility. His tweets, he doesn't go about things a standard way. His flamboyant language, all of these, I'm not going to get into my political stance today, but they do cause market volatility. I think when we're done with the Trump presidency, that it will be good for the stock market. It's no guarantee, but all the business people that I talk to have liked the tax cuts, have liked the deregulation, and most of them feel strong sentiment about what the future holds. All right, things have become more polarized politically, and I don't think that's going to stop, especially with the Democrats taking over the House. We're going to have, 2 against 1 and a lot of infighting. So I think that political polarization is only going to go up. That's going to increase volatility. Another negative is rising interest rates. The Federal Reserve has pushed up interest rates. That's a good and a bad. The good part of that is obviously without economic growth, you don't have inflation, and they wouldn't be raising rates if things weren't getting better. So in a way, that's a good sign, but it does have a negative effect on the market, at least in the short term. Trade tensions have been another negative that I think is going to turn into a positive, in that Trump negotiated a good deal with Mexico. They've got a trade agreement in with Canada. Right now they're working on China. I think that's all going to come out just fine. And when it does, I think that's going to be great for the markets. Two, very, very dominant countries getting a trade deal done. I think that's going to be great. Another positive negative, but I have it here under the negative column, is stronger dollar, along with weakness abroad, so that can have negative news on the market. America is leading the way. Other countries are not doing as well. Again, that can be negative for markets. And lastly, I don't know if I've ever showed you, but one of the things that we look at here is a matrix of every year, and generally it's divided up into 12 sectors, and they look at the asset classes all along the way. And generally there's 3, even in a bad year, there's going to be 3 good sectors. Last year none of that. It was just bad all the way around, which is not a typical. So that's the bad, and there is some significant bad in there, but I think that the bad is outweighed by the good. We've got our first trillion-dollar companies, Amazon and Apple, trillion-dollar companies. Who would have thought? I mean, that's a lot of capitalization. Retail's coming back strong, and what we're seeing here is companies that have figured out the marriage of big box and online technology are really doing well. Just a real quick story. I needed a new toilet. I sat here at my desk. I checked the Home Depot's inventory 2 miles down the road, figured out exactly what I wanted. It put the aisle and the lot number of the stuff on it. I went in, and I hate big box mostly because it takes so long to get in and out. I went right down to the aisle, I went right down to the lot, I got my toilet, and boom, I was out. So the companies that are figuring that out are doing well. The companies that aren't, JCPenney's is hurting, Sears went out of business, Bonton bad. Those companies haven't figured it out, so they aren't doing well. That being said, retail had a strong fourth quarter, so that was fantastic. Employment numbers stellar, 312,000 jobs in the last quarter, 10-month high. That's fantastic sign. Earnings, and I think earnings are really the key metric that I follow, and the one that I would worry about if it tailed off. But earnings have been very, very good. They've been strong for a long period of time. I wouldn't recommend any major changes unless earnings started to consistently perform bad, and then I might tweak some portfolios. So what have we been doing? We've been rebalancing as normal. We've been doing a few extra rebalances to take advantage of volatility. We're keeping a longer-term view. In stock portfolios, we've sought out positions that we thought we could take advantage of a downturn and buy some things at value. So we've been fairly active trying to keep your portfolios tuned up. What should you do? Hey, keep a long-term view. Think of the stock market like you bought a piece of real estate. You're not going to follow the price of that every day. It goes up, it goes down, but over the long haul, it's probably going to appreciate. If you keep that same mindset for stocks, typically you've done very well. Have cash on hand. I don't think that affects your portfolio, but I think having cash on hand is a confidence builder for when we do go through some volatility roller coasters. You got plenty of cash in the bank, and it just seems to heighten confidence. If you're still working, volatility and a lower stock market are great because you buy at a discount. So continue to save if you're still in the saving phase. So all in all, I think when you look at the negatives and the positives, things aren't as bad as the news might portray. And I'll just like to comment on that a little bit and then wish you a good day. Even here in my office, when the news gets really negative, and I typically watch Bloomberg, I watch Fox Business News and CNBC Business News. If they start doing the negative chant, I just turn the volume off. And even me, I'm a pretty stoic guy, but that protects my psyche from 8 hours of negativity, so I can go home and keep a good positive attitude. So long-term view, and try to eliminate the negative noise. Emotion is your enemy. We're your friends. If you ever need us, please give us a call. We love hearing from clients. I had a client call the other day. He got a little bit worried. He said, hold my hand. I talked him through it. He's good now. Don't get many of those calls. But if you ever want to give us a jingle, we'll be happy to receive your call. Always look forward to talking to our friends and family in the business. Myself, Andrea, Sue, we love to hear from you. So I want to wish you and your family a very sincere, happy New Year. I hope 2019 is a blessing for all of you, and we look forward to speaking with you all. Thank you.